Hello, everyone. Welcome to the opening playbook. We are going to start our pre-show to get people who are newer around here oriented to what we do. Whether you're new to trading or just new to our group, welcome to the opening playbook. Our mission here is to be a bridge for new and advanced traders to go beyond outdated market narratives into deeper understanding. We offer market insights as timely analysis of what's moving the markets right now, trading education to help you build real skills beyond surface level tips and tricks, and live trade ideas, real-time recommendations you can act on immediately. Opening Playbook is a free daily live webinar. Your hosts of the show are Nathan and Graham. Nathan has over a decade of experience trading Forex, stocks, and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's the creator of the Income Machine, overnight options, and more. He's a husband, a dad of 7, and the publisher here at the pub. Graham Lindman is also an options expert with over a decade of market experience. He studied technical analysis under 2 of the top minds in finance. He developed wrap order option trades for cost-effective entries, as well as created lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. He's also a husband, a dad of 2, and the copy chief here at the pub. Now, a lot of people in the stock market education industry will tell you that trading is easy if you just know their quote-unquote secrets. Well, that's not us. We'll tell you the hard truth, which is that trading is complex and takes time to learn. But we make the learning process much easier. The opening playbook exists because a lot of traders have trouble succeeding because they believe many of the myths out there about the market and trading. We'll dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful, whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. Now, it's important to remember that you should never trade with money that you can't afford to lose. Of course, nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or grocery money. So please don't trade with money that you can't afford to lose. And let's be ultra clear, any type of trading involves losing some of your trades. It's inevitable. Controlling your risk will keep you in the game, and we can help you learn structures and strategies to do just that. Our promise is that we'll be honest and transparent with you about what works and what doesn't, what you should make your own decisions about, and what rules we believe you should always follow. And here are some rules of the road to get you started. Stay calm. Try to trade without emotion involved in your decisions. Go at your own pace. Don't try to keep up with us or other traders. And ask questions freely. We really do want to help in any way that we can. And to help you get started, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner I'm posting above. And for answering that quick survey, we'll give you custom content to better help you by using your feedback to improve our classes and education, and give you a free options cheat sheet, a digital, easy-to-understand options guide that will look something like this. Now, I'd like to give you some tips on using our webinar platform before we get started with our regular program. The button next to number 1 here, we call the hamburger button. That will collapse the green column on the left, and you can leave it collapsed because we don't use it for anything. Number 2 is the pause button. You can pause and resume the presentation whenever you'd like. Number 3 is the mute button. You can mute and unmute the presentation's audio. If you find that you suddenly lose audio during the presentation, make sure you haven't accidentally clicked or tapped on the mute button. Number 4 is the main announcements section, where trades that we take in the current session will be posted, as well as helpful links that can always be found there. Now, this section will only be visible if you're on a large screen. If you're on a mobile device, You won't see announcements here, but we do have another area that you can see them that we'll get to shortly. Number 5 is the toggle for going between light and dark mode, whichever you prefer. Number 6, the monitor icon will enlarge the presentation area without hiding the communications or chat area. Now this button is shown in 2 places, and I highly recommend using this because it'll give you the best view of the presentation without hiding the chat from you. Number 7 is the picture in a picture button. This will reduce the presentation to a floating window so you can do other work behind it, such as go to your broker platform on a mobile device. Number 8 is the full screen icon. This button will enlarge the presentation to take up the entire screen, covering everything including the chat area. Number 7 and number 8 may or may not appear for you depending upon what device and browser you are using. Number 9 is the low latency button. Toggle this off if you're having any audio or video issues, such as buffering. Number 10, all the way on the right, is the communications area. This is where group chats, announcements, and private messages will appear depending upon the tab that you have selected above. At the bottom, number 11, is where you'll type your outgoing message. You can press enter or tap or click on the green arrow to send it. Number 12 is where you can start a private message to a host by tapping or hovering on one of their group chat messages and clicking the double speech bubble icon that appears. Now you can only private message hosts, not other attendees. At the top, number 13, that button will collapse the communications area, giving you a larger area for the presentation, but you won't see any of the communications that are going on. Number 14 is the group chat. This is where you'll read and write messages that the entire group can see, and this is the default tab that you'll see when you sign in. Number 15 is the announcements button. This is where you can see those same announcements that were in the larger area that we covered earlier, but this will be available whether you are on a mobile device or a larger screen. Number 16 is the private messages tab. This is where you can see any conversations that you have started with the hosts or they have started with you. And if you have a new message waiting for you, you'll see a red dot below this icon in the toolbar at the top. And last but not least, number 17 is the button that will pop out the communications area into its own window. This is useful if you have multiple screens and you want to go full screen on the presentation and view the chat in a separate screen. Now, we have a version of this guide that I just went through that you can view on your own. The URL to get to that guide is marketspg.com/wisepub, and there's now also a link to it in the announcements section. And that's it. So once again, welcome to Opening Playbook. Don't forget to complete that survey to get your free cheat sheet. And now we're going to play our theme song and get to the regular show at the top of the hour.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The Markets Playbook is finally here. Opening Playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh. Charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. This is where the big plays are made. Oh. Charts are lighting up the morning sky. They spot the trends with the hawk side. Motions and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh. Step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading phone. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that will fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Well, good morning, everyone. Happy Monday to you. We are starting just a minute or so early here. Got that theme song going just a few seconds early, but I'm happy to be here with you all. And we are seeing some choppy activity in the SPY today. Opened a little bit down from Friday's close. Looks like it's trying to work its way back up. Haven't gotten that signal on 60-minute yet. See what the boys have to say about it when they get here in just a minute. Hope you all had a good weekend. We will be getting to the regular show in just a second. How is everybody doing this morning? Anybody do anything fun over the weekend? Be the first Monday since Graham came back from vacation. Looks like 60-minute just dropped for anybody who's in there. Looks like we are going bullish. And like I said, the boys should be here in just a minute. Robbie Hollywood just returned from French Polynesia. That sounds lovely. Don B enjoying the Cali spring weather. Arnolfo got back from Colorado. People doing lots of fun stuff. Love to see it. Love to see it. The Netflix trade, Chris, I think if I recall correctly, I think we were just out of that with a profit, but I could be wrong. I don't recall off the top of my head where we were with that. And joining us now are both of the guys. Mr. Graham, how are you?
Hello, hello. Happy Monday, everyone.
Happy Monday. Nathan seems to be with us in all but picture.
There he is.
There it is.
How's everyone doing?
All right.
What a start to the week. I don't know if you guys all saw the news. Looks like bombs away again over
Yeah.
in Iran, but the markets, they opened last night nearly down 1%, and now we're flat.
I mean, the fact that they were only down 1% to begin with is wild. The fact that they're flat is even more wild. But it kind of goes back to I think what we talked about last week a little bit, which was the market seems to have decided that it's bullish now, and it like shrugged off a whole bunch of semi-negative news, all the way from that first initial 2.5% gap. The news hasn't been amazingly positive. It's been like, well, we're not really sure. Well, this might have, and the market, we'll just keep ripping. Like, so it seems like we are at that point where fundamentally we want to be more bullish, seemingly, and it's willing to shrug off kind of whatever it needs to keep going.
Yeah, here's an interesting stock this morning. I thought about buying it last night. I'm not huge on the space stocks as far as knowledge. I don't know a ton about the space exploration or even the upside of trying to go to Mars. But ASTS had a 15% drop overnight off of news of a Blue Origin launch failure. It's already climbed back 7% of that. So you can see here the gap down. It's going higher. This is one that's been a retail favorite, also a more speculative. Obviously, with SpaceX getting a lot of the headlines, ASTS has been kind of another one of those primary drivers that people are looking towards. This could be an interesting one, Nate. I don't know if you have any opinion on it, but ASTS looking like it wants to try to fill this gap very fast.
Yeah, I haven't really traded most of the space stocks either. I don't know that I have a strong enough opinion to actually, put any significant capital to, but from like a short-term risk-defined trade, I think that's, a beauty.
It's one that you could play the underlying stock as well for a nice return.
Yeah,
so I'm thinking about buying some ASTS this morning.
10% plus gap there.
Crystal
right
puts on
10%.
ASTS, so if you did that today, you should be looking pretty awesome.
Nice. I'm still waiting for silver to, really get going. It's had these kind of like gap up, fade, and I still think it's bullish. I'm just still waiting for like the, parabolic back-to-back 10% days in silver to really get me rolling here.
Yeah, I think right now for the precious metals, we're just waiting. We've obviously seen the S&P come back to all-time highs. What an insane rally again. Just to restate this is very, very unusual. However, if you guys look at interest rates in the bond market, it has not rebounded. So interest rates are still higher than pre-war. If you guys know about, precious metals, that's not good for the super cycle case. I do think as things settle down, we'll see interest rates come back down probably over the summer months. But until then, I don't think that gold and silver can truly fly until we see those interest rates start to decline again. There you go. Bodine says they deorbited Bluebird 7 satellite because the launch put it in too low of orbit. I'll put on my astronaut hat here and pretend I know what that means, but apparently not good of news. Yeah. However, we do, I'm not supposed to share this, but excited whenever we come back to a Monday morning and we get a signal in 60 minute to the upside this morning, one size. Check this out, Nate. I don't know if you've seen this in the 60-minute program. Jason did all the testing, showed us, hey, these are the best days to enter. Here's some days that were, underperformers. And so we made a ranking scorecard based on that, where one size would be our normal contract position, 2 would be a double, 3 would be a quadruple, and then a half size would obviously mean we're going half the contract. So look at the scorecard here, where we know right at the open, hey, what would it look like today? So we had calls early, which is a 1 position size to the upside. It'll be interesting. Obviously, this is just a very technical setup. Right now, we are going to see this resistance that we've already seen this morning off that gap close. I've got a little too small here. Let's see if I can do this. There you go. Getting to break even, we may see some resistance. If we break through it, Nate, can we have another green day? Is this possible?
Dude,
to do another green day here?
All things are possible. That's in Philippians, Graham.
That's true.
But it's also true about the market as well. It's unbelievable. As a matter of fact, the entire thing that I want to talk about today, and I'll get ready here in just a second. I want to update one stat here to make my case a little more compelling for everyone. But the entire thing I want to talk about is that question. So who all here feels a little nervous at this insane run to the upside? Just out of curiosity, how many of you are in the this is getting a little crazy boat? And maybe shorting, maybe just waiting, maybe feeling like, okay, we got at least need a pullback before we do, before we see what's next. I've heard a whole bunch of people talking about, it happened too fast, too aggressive, too fast. And I think logically that's right. But I'm not sure data wise that's right. And so I'm interested to just kind of walk you through just a couple notes and stats that I think are interesting. So
Well,
that's
I'm
the
interested.
main that's the
I'm
main thing I
interested to
have.
hear it because Nate, I did the grand vacation indicator. So I was in cash when I went on
Exactly.
vacation and this, and now I'm like, man, where's my entry point going to be here with my retirement account? But
Yeah.
so take us through it.
All right. I just wanted to update one thing here.
Cool.
And
Jason
then,
says earnings are on fire. That is interesting to me. We've had a 6-month lag in the markets as far as pricing and earnings upside. Could it be a catch up? I think it may be. We'll see. I don't know
well,
if you saw the Goldman Sachs, everybody increasing their revising it higher now. Just a little asterisk there. The
yeah.
analysts aren't always right.
Well, you guys are playing right into my hands because the next thing I wanted to
Oh
show you
no.
is something on earnings. So we'll see what we can get through today. I might go a little bit shorter today because I do have a little bit of prep to get ready. Lance and I are doing something here this afternoon, and I have a couple more things to go through with him. So I might go a little bit shorter, but I'll get through what I can. But it sounds like nervous and cautionary. Roxanne said, I'm traumatized. Well, that's one way to put it, Roxanne. And oh wow, Pio says, why don't you just go into SanDisk, man? I made all kinds of
Seriously.
money. What are you guys thinking? Yeah,
I did. I made like 40 grand, which is huge. Huge on SanDisk, and then left about another 60, 80 on the table.
Yeah. Well, the question is the market overextended, ready for a pullback? I think it's possible. I think if we got a down day today, a play right back into 700 for a retest would be probably a great trade. But is that the prevailing likelihood, or are we just ready to rip higher? We've talked about these V-shaped recoveries. They do tend to continue, but what does that actually look like in the immediate follow through? Well, let's take a look at the data. You guys know I always want to try to go back. History does not prove anything, it does not guarantee anything, but it does kind of give us some insights into the character of the market. And it's a lot better than looking at the market and saying, oh, geez, I feel XYZ. I feel like the market's too high. I feel like the market's gone too fast. I feel like the market's too low. I think the data is a lot better starting point than that. So when the market gets to all-time highs, especially when it's in this kind of crazy rip, I think you often start to hear, okay, we're overextended, we're ready for a pullback. Let's get into cash, all that kind of stuff. But really, and I've said this for years, overextended is actually not a real thing. It sounds good. It's a technical term that can be true technically, as in the RSI is too high. But as far as telling us directionally what the market's going to do, overextended is a really, really bad indicator. Just look at NVIDIA, 2018 when they said it was overextended, then 2020 when they said it was overextended, then 2023 when they said it was overextended, and it just kept going. Or like we talked about, all the gaps that never got filled. The reality is it's really not a good indicator of anything. How do we know that that's true? Well, the baseline stats after a SPY weekly all-time high close, which we got on Friday. SPY made an all-time high weekly close. 75% of the time, we get another all-time high close within 2 weeks. Okay, now that's really important because it's within 2 weeks, which means even if we get a pause, the next week combined, at least 75% of the time, is giving us an all-time high. It doesn't mean one of the next 2 weeks is bullish. So let me just trivia question here for you guys. Based on this stat, we close at all-time highs. We get a down week. This is week 1, okay, after the following. And then we get a bounce week like this, and it closes here. Week 2. Okay, let me ask the chat. Does this qualify for the statistic? Week 1 is down. Week 2 is back up. Does this qualify for the 75% statistic? Give me a yes or a no, just so that we're on the same page here, because the way that I look at this within 2 weeks, I think is really important. It's a lot of the basis of the automated option strategy, if you guys are familiar with that. Okay, the answer is no. It does not qualify, because the stat is 75% of the time it has to close not higher, not a high, an all-time high. That means if week 1 is down, if this week is down, next week has to close at an all-time high to meet this baseline. Okay, so this isn't like jerry rigging the stats. We're like, oh yeah, well, one of the 2 weeks is bullish, but the first one flushed it down and we never got a recovery. This is only counting if it goes to an all-time high. The reason I'm hammering that is because a lot of statistics can be tricky. Like, oh, within the next 2 weeks, 80% of the time we get a bullish candle. Well, that doesn't tell you that if you entered today, you would actually be ahead of the curve 2 weeks later. This is saying it has to be at an all-time high. So even if we get a down week, the next week then would recover a very high percent of the time. How about this stat for you? 99% of the time, we at least touch higher. Now, that might be by 1 penny, so this stat is a little bit deceiving. But the point being, if we get that all-time high, usually what we don't get is a gap down and a run. Hint, hint, we're down since the all-time high close. Historically, within the next 2 weeks, we have a 99% probability that we're at least going to fill this small gap we have today and touch the all-time high, even if we're going to go lower. So we have a pretty good indication that the market is not automatically overextended when we get an all-time high close, because 75% of the time we actually follow through within the next 2 weeks, and 99% of the time we have some, whether even if it's short-term, some follow through. Okay. So the verdict on buying new highs, well, it's definitely not time to short. It's actually one of the best continuation signals you'll ever see. In fact, Jack Carter, when he first came on, I guess this was about 5 years ago, he did a study on if all you did was buy stocks at their 52-week highs when everyone else says they're overextended. If all you did was buy every stock when it got to a 52-week high, you outperformed the market significantly, because the truth is all-time highs are great continuation signals, even when it feels really tricky and smart to say that the market is overextended. Now, like I said at the beginning, I do think Friday's close is a little more dicey maybe. We're coming off a super aggressive pullback and a super aggressive recovery. We have unresolved conflict. We have inflation still kind of hanging above us, saying, maybe we're not so good. So I think it's popular then to say, okay, even if all-time highs usually beget all-time highs, things are a little different. Things are a little dicey. I think what we often forget about the market is that usually things are baked in all the time. Like I often hear people say, oh, Nate, why would you do a trade on overnight options when we have earnings the next day, or we have Fed rates the next day, or we have something the next day? And what I often tell them is, well, all the historic data had all that stuff going on too, guys. This isn't the first time that we had Fed rates coming up. It's not the first time we have big earnings. All of the historic data, when you look at data like this, it's blending in all the same kind of stuff. Now, it might not be an Iranian conflict, but it might be, some other conflict announcement or, some other negative report. The point being, data by its very nature is taking into account normal scenarios that we think feel unique today, but really aren't. Iran might be unique, but there's other, negative announcements, positive announcements, crazy headlines, all of that baked in to the last 20 years of data. Again, it doesn't mean that historic data guarantees future realities, but it's just to say, if you're always thinking that, right now is so unique, then you're going to discard the reality of how the market moves in traditional market behavior at way too high of a degree. So let's ignore all the noise right now, because the market doesn't seem to care about that noise a whole lot over the last week. Let's ignore that for a moment and just go back to the data. And let's get a little more specific in the situation that we find ourselves in right now. So we had a new all-time high last week. Okay. We're going to look for the first all-time highs after a pullback. Okay. So if the market makes an all-time high, we're going to count it from there. We're not going to say, okay, the next all-time high counts, the next all-time high counts. And we're going to look at a pullback that has happened over the last 26 weeks. Why did I do 26 weeks? Because it's half of a year. So looking back over half of a year, when we make an all-time high, what happens on the follow-through from that reality? Historically speaking, I started in January of 2004. Okay, so we've got about 22 years. Well, the market has a 3 to 6%, a shallow pullback within 6 months of that recovery, about 56 times on the weekly chart. Again, only counting the first instance. This number would be 150 if you counted all the instances, but we're only counting pullback, then the first instance of an all-time high like we got on Friday. 6 to 9% correction, that happened 19 times. That's where we're at right now. 9% or worse. But it's interesting, by the way, if you go by the futures, we're here. So we're actually here on the futures, but we're here on the SPY underlying daily chart or weekly chart, which is just kind of interesting in and of itself. But these you're probably going to recognize as COVID, tariffs, etc., where you had the deep correction and then a recovery. All right, what happens in the follow-through of these three events? Now, I'm sure you guys can all guess. Do you think that the numbers are going to get more positive as we get into deeper recoveries, or do you think they're going to get more negative as we get into deeper recoveries in terms of what happens? In other words, do we think that this is a better sign of bullishness or this is a better sign of bullishness? Well, again, if you've been trading the last couple of years, if you've been trading since COVID, you probably have a good guess on what the answer to that question is. The shallow recoveries are still great. 68% of the time, it's more positive. The middle tier, a little more positive. 74% of the time, that's 6 months later. And what do you know? Those deep recoveries, 6 months later, 100% of the time, they are higher than we are at the all-time high close that initially set off the condition. Okay, so all we're measuring here is you have a shallow correction and the market makes the all-time high. You track from the first all-time high and you say, okay, what happens over the next 6 months? Well, 68% of the time, you're higher. And a lot of times you're significantly higher. If you go to a 6 to 9% correction, a little bit deeper, and you run the same numbers, what happens there? 74% of the time. And if you run those really unique deep corrections and come back 100% of the time, 6 months later, that's more positive. Now, the reason that I think this is a little bit fascinating is that I really think we're more in this category right now. Because if you go by the futures, we're at like a 9.8% pullback, which puts us just barely into this category. So maybe we're in between. So maybe my expectation is an 85% chance of 6 months later being higher. And so the thing that I find so fascinating about this is that everyone would agree the bigger the drop, the bigger recovery to get back to all-time highs, right? That's just math. That's true. The bigger the drop, the bigger the recovery. What's interesting, though, is that I think most people look at that and say, well, yeah, but the bigger the recovery, the more overextended. And therefore, it's these recoveries that everyone is saying, look for the correction, look for the pullback, look for the other shoe to drop, because it's these corrections that are so extreme. And yet it's the exact opposite. The crazier the comeback, the more overextended the recovery, just by definition, because the pullback was deeper, actually the more positive continuation sign that really is, historically speaking. Doesn't, again, mean guaranteed for today or next week or 6 months. I'm not saying that. I'm saying historically speaking, it's these very overextended by definition recoveries that have the highest chance forward looking of continuation. Before I go on, does that make sense? Is everyone tracking with me where I'm not talking about starting down here and giving it the benefit of the pullback? I'm talking about starting up here where it already made the massive recovery. Because remember, it has to close at an all-time high for it to even trigger this scenario. And yet it's in those scenarios where, historically speaking, we've gone higher at a much more substantial pace than what most people would consider a much better trade, right? This nice little 3% correction where the market is trending up. We have a nice little 3% correction. We go higher. Everyone considers this, technically speaking, a much better trade than the crazy overextended down, overextended up. Now we're waiting for the pullback. And yet, folks, historically speaking, that is the better trade.
I think most people are following. There were one or two people that asked before all the voting scrolled by, just to kind of define overextended for them.
So overextended would be a technical term where basically we say the market moved too much too fast. And so it didn't have that natural rhythm. So what people would say is what the market should really look like is it should have peaks and valleys. It should look like this if it's moving up. If it's moving down, it should look like this. It moves in waves. It moves in patterns. It has accumulation periods and then it breaks down, all of that. That's true in the sense that it's normal. What it's not true in the sense is that it's predictive. And I think that's where people get a lot wrong. Like, again, the NVIDIA example or the Apple example. People are still waiting for, 1987 gaps to be filled on Apple. It's not true in its predictive sense. Now, it is true in the predictive sense if you are willing to simply play the risk-defying numbers and look for a small correction. Okay. So where overextended is true is that the RSI is somewhat predictive if you look for a small correction. In other words, the market's overextended. It hit RSI 80 here. And now we look for a risk-defined trade that has a small correction, not a fill the gap, a small correction. Now, here's the interesting thing. I say risk-defined very, very importantly here. Okay. I don't want to get too in the weeds, but I do want people to understand this because it's make or break. It's really important. If you run the numbers on most stocks where you say, hey, if it hits RSI 80, sell with a, like a 1% stop loss and a 2% target. What you will find is that it's a narrowly winning strategy. I'm overgeneralizing here to make the point. I would like to be more specific, but I really can't. Most stocks, that's a narrowly winning strategy. If you, on the other hand, did it without a risk defined, and you simply said, hey, sell when it hits RSI 80 and hold it until we have some level of profit or some time horizon, well, then it's a losing strategy. And the reason for that is simple. It's that your losers, if you kept them uncapped, would be massively substantial because it's the same stocks that break this RSI 80 metric that would be an entry that can often continue 200% the other direction. They can continue. And so it's one of those situations where if you were kind of taking the underlying, the times that you're wrong, you're really wrong. That's okay in a risk-defined strategy, but in an open-ended strategy, it absolutely kills you. So I'm getting a little nuanced here, but just to understand that this idea of overextension can be forward-looking is true, but it's true under very specific circumstances. Like, yes, 55% of the time, you'll get a small pullback. Not 80% of the time, the market will recover all the way back down to where it started and get back to an RSI 50. That's just not true, and no data set on virtually any stock will ever show that being true.
And if I could just throw in for the people that are kind of really new to it, the reason that we talk about being overextended, we talk about that rapid climb up is because it's generally, when we say it's overextended, we generally mean that it's kind of unjustifiably high. It's not high based on really substantial, fundamentals or something like that, where it's justified to be that high, which is why it can be a little predictive that we expect that little bit of a pullback is more of a correction, right?
Yeah, although I would say that a lot of pure technicalists would say they don't even care. They just care about whether the prices move too far, too fast. Like the NVIDIA example I keep going back to, because the funny thing about the NVIDIA example in 2023 is people calling it overextended left and right, and yet the PE ratio was going down during that phase. So it was actually becoming a healthier stock as it went parabolically higher. But for pure technical kind of RSI overextended, they didn't care. They just said, hey, it's too many days up, short it. And here's another hint for you, by the way. If you want to trade overextended, trade it in good stocks and in the broad market and trade it only to the downside. The numbers are dramatically better. If you trade it only when it's overextended to the downside, you're a buyer, and never when it's overextended to the upside, you're a seller. For example, one of the best, most proven entry points for the S&P 500 is 3 red days. You can run it over the last 5 years, 10 years, 20 years, 30 years. It's a great, great, great short-term, medium-term entry. 3 red days in a row on the SPY is a buy. Guess what's not a great short entry? 3 green days in a row. It's just not. It's not terrible. It's like 50-50, but it's not great. Meanwhile, the opposite is one of the best, most like unconditional buy entries, because the market is not equal, right? It's not equivalent. When people say, one of the things I hate most is when someone explains a technical pattern and they say it works just as well the upside as the downside. Well, that's almost fundamentally incorrect on every asset that you could look at. And it's just like a silly kind of technicalism that people will say that unless you're looking at euro dollar or something that is by its nature been neutral for 20 years, it's just not going to be true. Sorry, this is a massive rabbit trail that we're on right now, but just to be clear, the whole overextended thing, it can be true. Just make sure that you understand the environment that you're saying that it's true in, and be very careful as just saying, hey, it's overextended, time to short, because that, especially on something, with a bullish bias, is going to be a very dangerous strategy.
My interjections tend to have a sidetracking effect.
It's all good. Okay. So, by the way, I thought this was interesting, which is that when you get these shallow corrections, I found this kind of fascinating here. These shallow corrections, they tend to kind of be more like the market is sideways, which makes actual sense kind of when you think about it, right? If the market is going up and then it has this 3% correction and then it closes at all-time highs, well, that's probably more indicative of a sideways market, which you can kind of see here. 1 month later, you're up, or you're down 0.1, and 3 months later, you're up 0.47. That's probably more indicative of a kind of low conviction sideways market than a actual correction and a recovery. Whereas you see here, 1 month later, you're starting to make some ground. 3 months later and 6 months later, and the deeper correction, even more so, is building on itself. So I found that kind of fascinating. We usually think of that little shallow, again, this pattern is like the pattern that everyone, technically speaking, would say is the best looking pattern you could trade. Nice little shallow correction, a break to all-time highs. Well, maybe not. It's kind of showing you the market's a little bit lazy. And historically speaking, and by the way, 56 occurrences on the weekly chart, that's not nothing. We're not talking about massive data samples since we're talking about weekly all-time highs. You're only going to have so many, but it's enough to say there might be something to that. When the market is kind of lazily recovering from lazy pullbacks, well, maybe the market's just lazy for that period of time, and you're just not going to get a whole lot of momentum. Historically speaking, I think there's a case to be made for that.
It's also, we don't tend to look at 8% up and down as chop. Like that's significant movement.
Right. So SPY closed last week. Not sure if anyone knows. A pretty big week last week. Closed at all-time highs. The 26-week peak pullback, again, on the futures is a little bit bigger, but on the underlying SPY, 8.6%. We fall technically into the 6 to 9% correction. We have 19 historical analogs since 2004. 74% of the time, we're up 1 week later. 63% of the time, we're up 1 month later. So this is interesting. In this middle case, we get this, very often, we get this pattern where the market makes an all-time high, it overextends a little bit beyond that. Then we have a little bit of chop, and then we have the recovery, which I think is what Chris Pulver suggested he thought we might get. And historically speaking, that might be the overextension. It's funny not to turn this into a conspiracy theory about trading, but it's funny that this 1 week is a little bit higher. It's almost like the market makes that big rally. Everyone feels their max pain in the rally, and then one more week just to flush out a little bit more capital, and everyone says, "Oh, I guess it's just going up." And this, well, no, actually, we'll kind of chill out a little bit here. It's almost like the market is doing that thing of the least expected, which is very common. It's like, I'm sure some of you guys have felt this on individual trades, right? I've done this many times on individual trades. Oh man, this market just can't keep going. I'm going to short. Oh, it just keep going. Blew up my short. Huh? I guess it's just going to go long. Bye. Okay, now, we've all experienced that on individual trades. And that's kind of what you can see the market doing in macro here on these cases. Now, we're talking about 19 use cases, right? So let's not go bet the farm on 19 data points. But just historically speaking, that's kind of the cadence that we see. And then 6 months later, we see that 74% of the time recovery. Now, like I said, I would lean this more toward the latter bucket because we actually are, in my opinion, in that 9 to 10% correction, true peak to valley. So maybe I'm a little bit more bullish than what these indicators would suggest. But I think Chris is probably onto something. Beware of the neutral. When everyone's saying it's either exploding or we're going to correct back down, beware of the neutral that we might see here for the next month or so. I'm probably more bullish than Chris, but I think being careful with that just neutral chop that makes everyone unhappy is what you have to be most careful with in that environment. If you guys want to look at it visually, I'll show it to you visually here real quick, and then I'll show you something that will go a little bit deeper here on Closing Playbook, because Closing Playbook is back Monday through Friday. By the way, just out of curiosity, I think I already got a poll, so don't yell at us too much here. But just out of curiosity, give me your take on the adjusted schedule last week. Our goal was, number one, to give our traders a little bit of a break where they weren't live Monday through Friday. But number two, to let you guys expose yourself to some other classes that had less overlap. It seemed like, if I could be so bold, you hated that. But let me know. I'm curious. I feel like some people were like, no, it was great. I got to hang out with Jack a little bit more, et cetera, without missing anything that Nate and Graham were doing or that, Kane was doing. But we will probably have some more alternate schedules in the future. Maybe we will be less reductionary than we were. But I'm curious the overall feedback. I think generally speaking, it was we didn't love it, but I'm open. Kathy says, "Yep, hated it." Deborah said 2 chaotic. So maybe, as a couple people said, maybe they just didn't understand. Maybe the schedule just wasn't clear enough. We tried to post it every day, but there's so much going on that maybe it was not. So if you guys don't mind me using up a little bit more of your time. Just because I am trying to get actual feedback here. Can you guys tell me, for those of you who said you were not a big fan, was it more the lack of clarity of the schedule or just wishing that there was more content and the shows were going every day? So maybe if you could just answer that as a follow-up. I'm really trying to get good data here as we make some of these decisions going forward. We want to give people the occasional break. We want to expose you to some other stuff. But we also want to make sure that people aren't, annoyed and missing the content that they want.
I mean, we could post, we pretty much knew what the schedule was at the beginning of the week. Instead of posting daily, like in Telegram, we could just post like a full schedule for the week and kind of give people that in advance so they could kind of lay their week out if we wanted to.
Yeah.
If they wanted
Well, it sounds like clarity was maybe as big of a challenge as the actual content itself, which I could see. Someone said when the one they caught were slideshows. Well, the live schedule, like what we would consider the live schedule, we definitely did know, to Dave's point. So we definitely could point you in that direction, I think, a little bit easier going forward. And we could also probably, we have a live website that we're working on right now that will have a much more intuitive, dynamic demonstration of what's live and when it's live, which might help as well.
Did anybody find a new show that they hadn't seen before? You know, I mean, that was part of the goal also, is to kind of expose you to other shows that you might not be seeing because of the overlap.
Yeah, Dave, those are the 80 people who aren't here today who said after seeing other people, they didn't realize how bad I was and they were never coming back. Well, Graham was on a different vacation. He was out of the country on a different trip, so that had nothing to do with this schedule. Real quick, while you guys are giving feedback, and by the way, I really do appreciate the feedback. It's very helpful. We're trying to make these decisions, obviously, around you guys first and foremost. Yes, partly around our team and making sure that we can operate efficiently for them, and we want to do what's right by our team. But specifically, it is around you guys that we're trying to make it valuable, easy to understand, easy to follow, etc. And so the feedback is very helpful. Just to show you guys the kind of the database that I pulled for the data I just showed you. This is what it looks like. In case any of you guys are nerds like me and you like to look, but what probably will jump out to you, I labeled over here anytime the week closes an all-time high. And you can see they tend to show up in bunches. As you scroll down, you have lots of weeks with no all-time high, some scattered around, but you can kind of see the all-time high closes tend to show up in bunches. We get one every once in a while, a couple weeks without one, and then we'll have a run. Look at this. Whoo, doggy. That's 2022. That's a lot of weeks without an all-time high there. That's 2022. I'm scrolling back and forth through right there. But then bunches. Weeks without it. Okay. Do you guys see how rare it is to have one all-time high in a desert of non all-time highs? They usually come in after the desert and then they trigger a series of all-time highs. And remember, the beautiful thing about a series of all-time highs is that it's not just up weeks, it's all-time highs. Meaning anywhere you bought, you're up on the trade. It's really important because a lot of people will show this data and they'll show green versus red, up versus down. That doesn't tell you nearly enough about whether you should actually be buying, because if the down week was 3% and the up week was 1%, well, you're still behind the 8 ball. But here we're saying it has to be all-time highs. And you can see how rarely you just get one. Usually you get one, maybe a pullback break, but then more. And it's all-time highs. The market didn't just have to go up. It had to go up and recover all the way back. So this is going all the way back. I'm in 2013 right now. Big long stretch of pullbacks here after the rough ride we had in 2008. What do we have? 400 weeks without an all-time high? Is that what we had? Something like that. Notice in the 400 weeks or whatever it was, I think it's something like that, of no all-time highs, we didn't have any fake outs. You guys see that, right? We didn't have any fake out all-time highs that got you stuck in another 2-year drawdown. They just didn't exist. And then once they started existing, again, I'm scrolling all the way back up, well, they started happening more. So that's the beauty of the all-time high, is that it's a pretty darn good trigger of what's actually happening in the overall market. And you can kind of see it here in real time as I scroll by. So hopefully that's helpful. Now, the next data that I'm pulling for you has to do with earnings. We'll cover that in a little more detail on closing playbook, but just for funsies, here's the data that I'm pulling. I'm showing the stocks where they were 2 earnings ago, the underlying price, versus where they are now, versus how much the company has grown. So what we're going to do here is we're going to compare 6-month revenue growth compared to underlying stock. We're going to see if we can isolate some good catch-up opportunities. So, for example, earnings growth on Broadcom is up 20% in the last 6 months so far. The stock is down 1.45% in that same range. If Broadcom delivers good earnings, it might have a good catch-up opportunity. Check out Booking Holdings. Revenue's up 90% while the stock's down 6%. Might be a catch-up trade. So that's what we're going to do on Closing Playbook. We're going to look at this dashboard I built where I mapped out where have companies grown a lot, but the actual underlying stock is lagging behind. And those might be some of our best opportunities. There's a whole bunch of good ones that I find interesting. If they can parlay another good earnings on top of a lagging behind market, then I think we have something interesting on our hands to potentially be targeting for some of those earnings plays. So keep an eye on that for Closing Playbook. And then for those of you who are members, you should also have got an invite for 1:30. Wayne says the Monica and Ross of the group. Wayne, I'm more of a Chandler guy.
I asked him which one of you was Monica, but he didn't answer.
Can I be Chandler? Okay. Well, hopefully the data was helpful. We nerded out a little bit as we tend to do on the session. Appreciate you guys being on as always. Graham gave you a preview of some of the stuff that he and Jason have been working on. They have been going crazy on two different strategies, both the 60-minute and also the dollar trades are the two that they've done a lot of research on. And it's been really fascinating to kind of get the behind the scenes look at that. So if you like today's session on the data, then you'll really like what they're doing on the dollar trades data, I think. If you guys aren't familiar with that presentation, and I think we're going to play it here right now. Again, you guys know the drill. Profits, performance, not typical. We're not going to guarantee any future earnings because, of course, you could lose money on any trade that we talk about. But every single trade here is based on real trades sent out in real time. This is not a back test. It's not paper money. The average return here, winners and losers, 32% per trade in 4%. Guys, that's winners and losers. That's that average return we were talking about. 66% win, and there's my favorite number. An average win of 93%, even though most of these stocks barely moves. So obviously can't guarantee specific future results. There's always a high degree of risk. If you want to go through, just go to Prosperity Pub and you can read all of that. So welcome. If you guys don't know me, I'm sure you do. I'm Nate Tucci. I'm the publisher here at Prosperity Pub. And when most folks are paying, $500,000 or even more to trade popular stocks like Apple, Nvidia, or Google, one Florida-based trader discovered a new way to tap into what could be some of the most cheap options in the market that you can take advantage of. Trades costing right around $1, right around a good George Washington there to get in. And with this unique trading